how to be a better investor when it comes to forecasting financial statements. So what we're going to do now is we're going to look at some of the best practices when it comes to creating financial statements. And I'll look at just some of them. So let me go here and make this bigger. And I will click on number 71. All right, so I'm going to go through just a couple of these, not all of them. Okay, you can go through this in your own time if you want to. You can click on the videos in here to learn much more about every step to value a company. And of course, I teach you this in much more detail in my MBA program. So here are the rules. Modeling is easier than you think and a heck of a lot of fun if you remember two things. Number one, most items you model are simply a percent of revenue. Number two, modeling is all about looking for patterns, okay? You look at patterns and project them in the future. Like an object in motion will stay in motion. You project the pattern as well. Okay, number three, with publicly traded companies, they're large, a lot of them, and as a result, growth is positive, but revenue growth is almost always decelerating for 99.9% of all publicly traded companies. Revenue growth is positive, but it's decelerating. Okay, the derivative is slowing quite a bit. And so if growth is not decelerating for a large company, meaning slowing, okay, then it probably means they made an acquisition. And so I do a lot of M&A stuff as well to help you understand exactly how financial models work. So we're going to open this box here in a second. Now, this box here, oh, it's so heavy. This box here, okay, it says inside this box is the secret to making your fortune. Okay. And then right here, you've got a price of 1,000. What does that mean? What was this brick here? This is like Mario Brothers. All right, cool. And my kids are at the age, my youngest one, where he's like, Daddy, can you help me out with Super Mario Odyssey? I'm like, okay, fine. Twist my arm. Okay. He wanted me to use a yellow one. Okay. But if we spin this brick around here, you see earnings of 1. Okay. And so you're probably thinking to yourself, Chris, you're crazy. That doesn't make any sense at all. You're going to pay 1,000 times? Well, for decades on Wall Street, people would tell me, they'd say, Chris, you're crazy to invest in Amazon many years ago, as it trades at like 100 or even 1,000 times earnings, if they have earnings at all. They would say, Chris, you're also crazy to invest in Tesla because it trades at close to 1,000 times earnings. I mean, Chris, in Harvard Business School, 2/3 of which is BS, in Harvard Business School, they taught me only to buy stocks with low PE multiples. And what happened was I heard that over and over and over again in my career. You know, that's theoretical garbage. You know, people would tell me in the hedge fund industry years ago, they'd say, Chris, investing in Amazon at 1,000 times earnings is a widowmaker. Chris, you're crazy to invest in Salesforce.com or NetSuite or eBay many years ago, or Palantir when it was private, or Facebook when it was private. Now, I pride myself in always ignoring the market, and I always do my own research, which has humbly made me a lot, humbly. And I want to share many more of my investment best practices with you. And the best advice I have is always do your own research, okay, with the tools I provide you with. Now, one more thing. I guess I have to open this up and show you guys. Let's make this dramatic. All right, see how this is going to work out here. All right, so let me open this up. I can't remember what's in this thing. We'll see now. All right. Now, there's a secret inside this thing, okay? A secret. And let me open it up and show you the secret that's going to make you a fortune in the long run. Ooh. Oh. Interesting. Interesting. Wow. Wow. It's a secret here. I'll have to show you in a second. Okay. Now, before I show it to you, I want to say that the best investors do their own research. The best investors are contrarians. They don't think like everybody else. The best investors are in it for the long run, and the best investors create their own financial models, and they never value a company based on this year's earnings or next year's earnings. The best investors build their own income statement forecast and financial models at least 10 years into the future. And the best investors value companies that they invest in based on their earnings estimates in 10 years. So the side of this box says 1,000. So you're telling me, Chris, to pay 1,000 times earnings for the stock? That seems a little high. Why would you pay $1,000? It's not 1,000. That's what everybody thinks. The secret is you forecast your financial model out 10 years, okay? And in 10 years, earnings can be $1,000. So your earnings estimate is $1,000 in a decade, and now the stock is cheap at a price earnings multiple of 1. Pretty amazing, huh? So the earnings estimate for me on many of these companies was $1,000 in earnings in 10 years. Okay, so now it looks like a pretty damn cheap stock. That's how you have to think, dude. You got to be long-term focused. But Wayne Gretzky was my hero growing up. And he said he was successful not because he skated to where the puck is, but rather because he skated to where the puck is going to be. Similarly, we need to buy stocks that people are going to like. How? By forecasting our model 10 years into the future so we can value companies based on our earnings estimates, meaning our earnings in 10 years. With this long-term mindset, you will make a fortune. It's kind of silly seeing people trying to trade stocks in the market to make 15 or 20% per year. I don't do that. I build out financial models and I look for what are called 5 baggers, which means a 500% return in 5 years. And the only way I can do that and ignore the volatility and the naysayers is to think long-term and build up my own financial model with many of the tools that I'm going to provide you with. And I've done really well with this. One more thing before I open this briefcase here behind me. I almost forgot about this thing. Yeah. It's just levitating there. Yeah. When you buy stocks, it's offensive, okay? Meaning you're trying to score a goal. And I'm about to publish a massive update to my MBA program with the addition of how to make a fortune with options. And I'm actually going to show you in a second, I'll go off script here. I'm going to show you a ticker that I guarantee you will tell you exactly when to buy stocks. And it is always right. It's always right. This is going to blow your mind. So let's go to Yahoo Finance. Never pay for any financial data or any stuff. Get it all for free here, okay? And what we'll do is we'll type in VIX, okay? And don't forget the little chapeau, accent circonflexe here. The VIX is, it measures volatility. It's part of my options course, okay? And basically what it does is the Chicago Board of Exchange, which is one of the big options markets, they created this vehicle back in 1990, okay? And basically what this means, and every chart tells you something, and I'll tell you what this chart tells us in a second. But basically what this means, the VIX, is it measures options volatility that the market is expecting in the next 30 days, okay, on the S&P 500. And when volatility is high, and it's something I'm going to teach you a lot about in the options stuff going into my program soon, but if volatility is very, very high, then what happens is the price of options go up and there's fear in the market. Okay, so right here, the VIX, it spiked initially around December of 1990, and that was during Gulf War I. A lot of fear. And then it spiked again in the late 90s, okay, when there was a fear of Asia falling. There was something called the Asian flu. Nothing to do with COVID, just the markets were in turmoil then. Then, of course, it peaked again around 9/11, right here. A lot of fear. And every time it peaks, I'm showing you, okay, big peaks is when everybody sells. And Warren Buffett once said, I love this quote, he said, the New York Stock Exchange is the only store in the world where consumers sell stuff when it goes on sale. And I want you to be a contrarian, and I want you to be unemotional in business and in finance, and I want you to profit immensely by buying at the right times. And I'll tell you exactly when. Okay. And then right here, it spiked again when the statue of Saddam fell. That marked the bottom for the market. The market was rallying big time because fear was low. See here, after that statue of Saddam fell. And then by 2008, when we were within 24 hours of bank machines not working in every country in the world, fear was at its highest and the markets bottomed. And it happened again last year. So this here reached a reading of almost 80. And intraday, you can't see this. This is March of last year, but intraday, it actually went well above 80. And that's when really unemotional investors like Elon Musk backed up the truck and bought a lot more Tesla. So no matter what you feel, if you ever see the VIX spike again to above 70 or 80, it's going to feel like death, like the world is ending. I want you to back up the truck. And I put my reputation on the line in this. It's helped me a lot in my career. You got to be a contrarian. If you buy the same stock everybody buys, you're never going to make money. Because who's the incremental investor to push that stock higher? Okay, so I've got this options stuff coming out, okay? And this will be quick, I promise you, but I love teaching. Now, I mentioned offense when it came to the hockey stick, meaning you make money by scoring a goal. How can you use defense to protect your stocks? How can you do that? I'm from Toronto originally. These are the Maple Leafs. We never win the Stanley Cup, but I still love my team. I'm loyal. How do you use defense? Well, offense is making money when stock goes up. How can you use defense to protect your stocks and maybe make money when stocks go down? Well, you can use options to buy what are called puts. Okay, and I'll show you exactly how to do that. And you can also short stocks, which is the opposite. And I'll teach you all that as well. I'm adding a ton of new stuff in the next 2 weeks to the program. Anybody that bought it in the past, the program gets all that stuff for free. Anybody that buys today gets all that stuff in the future forever. But there's tons of different inputs, okay, into options. And options is really poorly taught. And humbly, I got the top grade at Columbia in my MBA school, and I majored in finance in options. And I still didn't get it until I worked in the hedge fund industry. But there's so many different inputs to creating an option. And I'm going to make it fun to learn. A lot of fun.